Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Today, Investment Director Tom Stevenson joins host Pamela Ritchie to dive deep into global market trends and what top issues are facing the global economy. Tom highlights rising inflation and interest rates and how central banks in the US and UK are grappling with these challenges. He says it's still an ongoing debate between classifying the current trend as a mild economic slowdown or an indicator of a deeper recession, emphasizing continuous uncertainty surrounding these potential outcomes. He points out Germany's economic struggles, particularly its manufacturing sector, where some automobile companies face declining demand from China, as well as a loss of access to cheap energy. This downturn reflects broader global pressures and impacts electric vehicle tariffs. Tom also discusses his optimism about the UK and the European commercial real estate market, suggesting there are opportunities to be had in its current pricing. This podcast was recorded on September 23rd, 2024.
Last week was just a dizzying interest rate week for many corners of the earth. Let's talk a little bit first about the discussion of rate cuts. Bank of England's decision, which got moved, they started moving on interest rates earlier than certainly the US. What did you take from the message from Bailey about interest rates and where they go from here for the UK?
Yeah, well, it was a busy week for the UK for the Bank of England last week, because we not only did we have the rate decision, but we also had the inflation report the day before, and so that was an interesting setup for the Bank of England, because the inflation figure is sending out pretty mixed messages here in the UK. So. The core rate, the underlying rate, the headline rate, very close to target, 2.2%, which is exactly the same as the previous month, 2% target, obviously. So that's on the face of it good news. But scratch beneath the surface and you see that the service sector inflation actually rose 5.2 to 5.6% month on month. So that was quite a big increase. The core rate of inflation that excludes volatile elements like food and energy also rose 3.3 to 3.6%. So the bank is on the horns of a dilemma, really, because there is evidence that the economy is slowing. Output really stagnated in June and July. But at the same time, the sticky elements of inflation are pretty persistent at the moment. So they didn't move on interest rates. They had cut in the summer, quarter point cut, preempting the move by the Fed. They held rates this time, and I think the expectation is that the direction of travel is set. Interest rates are coming down, but I think the trajectory is going to be slower and shallower than maybe it is in the United States.
What is the domestic story out of the government right now? This is Chancellor of the Exchequer, Rachel Reeves. She's come in. I mean, I was reading the FT over the weekend, and there were lots of discussion of essentially austerity. Like it was sort of well, it's a scary word to a lot of people. That things that are going to have to get quite threadbare and cut down to the bone. Today's message, tell us about it. It had a different tone.
Yeah, so I think the new government is finding its way a little bit in terms of communications, because obviously they've been in opposition for 14 years. They're kind of new to this, and the approach that they've taken since the election in July is to really talk down the prospects for the British economy on the basis that any government has a relatively short honeymoon period in which they can blame the previous government for the state of the economy. And the new Labour government has taken advantage of that in spades. And they've said, look, we've discovered this £22 billion black hole, which the previous lot didn't tell us about. We're going to have to fill this gap. And the people with the broadest shoulders are going to have to bear the biggest burden in helping us do that. So they have been criticised for painting too pessimistic a view of the economy, not least because they were elected on a ticket of saying we're going to go for growth, We're going to go for increased productivity. And now what they seem to be saying is things are really bad and we're going to have to clamp down, higher taxes. We're going to have to do things which are actually going to make it more difficult to generate growth and increase productivity.
And the taxes that they're thinking of raising are the ones that have been telegraphed. Are sort of taxing the rich, essentially. I mean, that's where they're going for this messaging so far.
Well, what the Chancellor has done is she's rather tied herself, painted herself into a corner, because what she has said is we will not touch taxes on what they call working people. So they said we will not raise income tax. We will not raise value added tax, VAT. We will not raise national insurance, which is just another form of income tax, essentially. Problem with that approach is that those are the three biggest revenue raisers. So by making them out of scope, they have really made it very difficult to address that problem of the so-called £22 billion black hole that they have to fill. And the taxes that are left, and where the speculation is really around the taxes which are principally going to hit wealthier people, higher earners. So we're talking about capital gains tax, inheritance tax. There's a lot of talk about the taxation of the pension system, whether it actually favors higher earners, rich people, which it does. So there is an element of redistribution going on here at the same time, but it's amazing with the impact it's had on confidence. We write a lot and we talk a lot about these issues, and we obviously track the interest, the traffic to our website on when we write about these things. We have seen when we're writing about capital gains tax, inheritance tax, pension taxation, the volumes have gone through the roof. People are really concerned, and people are actually acting on this. We've found. I'll give you a good anecdotal example of this. My daughter and her husband have just bought a house, their first house. They bought it off a buy-to-let investor who is cashing in before the budget because he's convinced that capital gains tax is going to be significantly increased on second properties. So, and that's, obviously that's just one example, but this is quite widespread. People are really beginning to manage their personal finances in a way which is looking at that budget, which is coming on the 30th of October.
That's fascinating. And this will be their first crack at it. And as you say, they've been in opposition for over a decade, sort of somewhat waiting for their moment. It's quite a big budget. We'll certainly be paying attention and asking you to parse it for us when it actually does come through. Can you just let me know a little bit from the investment case for the UK, what was in the message today in terms of, is it austerity in the way that the economy might feel that, or is there sort of an investment for growth that you would think would also be appealing to investors?
Well, there has definitely been a shift in tone, because I think the government has slightly understood that they've overplayed the negativity in the run up to the budget, and I think that they were elected on a ticket of growth, productivity, and I think they want to deliver a more positive message. So what Rachel Reeves was saying today, because the Labour Party here in the UK, we have these annual political party conferences in the autumn. So last week was the Liberal Democrats, this week is the Labour Party, and next week is the Conservatives. So Rachel Reeves, the Chancellor, was speaking today at the Labour Party conference, and she was talking about investment and the importance of investment as a way of driving growth in the economy. Growth being the best way to fix the problem with the public finances. So I think everyone agrees with that. And the problem that the government faces is that they have some self-imposed fiscal rules which make it quite difficult for them to implement the investment in the economy that they need to do. So one of those, for example, is that there is a cap on the level of government debt as a proportion of the size of the economy in 5 years' time. That's quite a constraint on what they can spend. There's another fiscal rule which is around balancing the budget um, 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 on everything except investment. So
Okay.
I think that what we're going to see in the budget actually is a change in the rules. I think the government is going to change the rules to make it easier to implement investment in the economy. The interesting thing there will be, how will that be taken by the bond market? Because
Sure.
we have echoes, of course, of the 2 years ago, the unfunded tax cuts of the short-lived Liz Truss government. Thus far, the markets have really given the new Labour government the benefit of the doubt in
Mm.
terms of their fiscal responsibility. And it will be very interesting to see on October the 30th how, and indeed in the run-up to the budget, how the markets appear to be treating the plans of the government.
That's fascinating. And just to see ultimately how, yeah, how anything that's unfunded, how will it be funded and so on. As you say, there's a lot of goodwill in the whole equation. So we'll come back to the UK, but I wouldn't mind just going further afield. Tell us a little bit about what you thought from the global perspective of the interest rate cut in the United States. Last week, it was 50 basis points. How does that help the global investor at this point?
Mm, mm. Well, I mean, it was interesting, wasn't it? I mean, there was a lot of ink spilt on, would it be 25? Would it be 50? Of course, it was 50. And I think it could have been taken, one of two ways. I think, investors could have looked at a 50 basis point cut and thought, well, what's the Fed worried about? Are they really concerned about growth now? Um, do they see a recession coming down the track? That isn't how it worked out. And I think investors took Jerome Powell at his word, that this was presented by the Fed as a kind of catch up, a recalibration of interest rate policy after a year in which interest rates have been pegged at a 23-year high of, between 5.25% and 5.5%. So it's been a long time that they've held fire. And I think the market said, okay, that's fine. I think we can accept that this is a bit of a catch up. And what Jay Power had to say about the health of the economy was, it was a bit of a Goldilocks scenario that he painted. Actually, he said, unemployment is not too much of a worry. Growth is not too much of a worry. Corporate earnings are heading in the right direction. Interest rates are going to come down. I think from an investment point of view, you could argue, well, what's not to like? There's a lot going on, and that's in the US. But if you look more broadly around the world, I think this divergence that we're seeing opening up between US interest rates and interest rates in other parts of the world is beginning to have an impact on the dollar. A weakening dollar is potentially quite interesting for emerging markets, for example. And so, yeah, and here in the UK, we're seeing the pound at a much higher level than it has been recently. That's quite good in terms of imported inflation here. So I think a weakening dollar is quite helpful for investors around the world.
Okay, yeah, there's a stimulative effect. You've mentioned EM, and so let's dive in there for a minute, because the EM story goes hand in hand with a weakening US dollar, which is exactly as you pointed out. But the EM story is a fascinating and changing. I mean, the economies are so dynamically, you know, tied to their own destiny in certain ways that it seems to change all the time. EM is not just China. India is a massive part, but there's also interest rate differentials with lots of other countries going around the world. Is the EM story of interest right now?
Very much so. I think the EM story is quite nuanced at the moment. And I think our view on EM is slightly changing at the moment. I mean, the way we look at the EM is there are sort of three main factors. There's the whole interest rate and inflation question, first of all, and we saw that we see that as a positive, because many emerging markets were early into this game. They raised interest rates, they got on top of inflation, and they put themselves in a position where once US interest rates started falling, that would give them the headroom to bring their interest rates down further. So I think that was a positive, and I think that still remains a positive. Although in certain places we're seeing, slightly mixed messages. In Brazil, for example, interest rates actually went up by a quarter point recently. So I think that's still a positive. Then the other two elements which we thought were really important for EM was, one, China, because China is such a dominant part of the whole EM universe, although a much smaller part than it was even just a few years ago. It was actually overtaken in terms of weighting within the global index by India recent, which is a fascinating development. But the China situation, I think, is the reason it was a positive for us was because we felt that China had become so cheap that with some stimulus from the government, we felt that there was a potential for a change in fortunes in the Chinese market. I think we're slightly less confident about that now, because the property market continues to be extremely poor. That is having a big negative impact on consumer confidence and spending. And so, and this has been reflected in the performance of the Chinese stock market. We've seen since the peak in 21, when China was seen to be coming out of COVID earlier than everyone else. Didn't work out that way, but that was the perception in early 2021. Since then, the CSI 300 index of Shenzhen and Shanghai quoted stocks is down by nearly 50%. And that's against a backdrop when the rest of the world's markets have gone the other way. So China, we're slightly less confident about. And then the third element, which we felt was a positive for emerging markets, was commodities.
Right.
And there is still a strong positive story for certain commodities. Copper, the long-term sort of super cycle thesis for copper, on the back of the clean energy revolution, electric cars, data centers. There are lots of reasons why you would be positive about copper, but at the same time, it's also linked to that China story, that demand for commodities weakening from China. We've seen that with the oil price down at $70 a barrel. We're seeing it with base metal prices as well. So I think emerging markets, yes, falling US interest rates, falling US dollar is a positive, but it's a nuanced question. It's not a simple, let's buy emerging markets now. And also, I think, just finally on this, I think there's a holding pattern element as well. Until that US election is out of the way, the whole China story is unanswerable.
Okay. Unanswerable because of the tariffs piece of this. We don't know which direction that goes in at this stage.
Exactly right.
Yeah. Okay.
We simply don't know. I mean, what we do know is that whether you're Republican or a Democrat, the perception of China as a threat is the same. So I think we know that the tariff situation is not going to go away and everything's going to be fine from that perspective. But there are subtle, and not so subtle differences between the two sides.
Yeah, fascinating. If you were to take a look at China, are there other places that China tends to buy from? I mean, Europe used to be in certain pockets. It could be a play on China, actually.
That's a very interesting point. Yes, I mean the question: invest in Europe as a proxy for China, as a safe proxy for China, doesn't.
Does that hold?
I'm not sure if it does hold anymore. I mean, what we're seeing in Germany, for example, Germany is obviously the engine room of the European economy. So we had some PMI data out today. I think it was the worst PMI data in 8 months in Germany, particularly manufacturing. I mean, so if you think about the manufacturing story, and the sort of the poster child for this is VW. I mean, we've seen VW closing factories in Germany for the first time ever. since the company was founded.
And is that linked to China? Was that specifically cars that were being sold on to China, for instance?
Well, I think the reality is that China does not need European cars in the way that it did a few years ago. China is churning out plenty of fantastic cars of its own,
Mm,
and that is a real problem for the German economy. The other problem with the German economy, manufacturing in the German economy, is that it was really built on cheap energy,
right.
and cheap energy is no longer a given.
Yeah.
And so, on two fronts, I think the German economy is struggling a little bit.
Can you speak to the EV tariffs? This actually comes back to the United States and China, and the discussions there. But we're talking about cars and EVs. Yeah, just a couple of thoughts there.
Yeah, I mean, I think I I think that the whole tariffs question is a really knotty one because the numbers that we're talking about are enormous, and it's kind of the end of an era. This whole and this is a big worry for China, but it's also a big worry for other countries because if you look at who will be hit hardest by this, it's probably the lower income categories within countries like the US who have benefited massively from cheap Chinese imports. If you start slapping tariffs on, and it's not just EVs, it's food, it's low cost um, household goods, it's all sorts of things. The people who are going to be hit hardest by this are lower income families. It's going to be inflationary. And I think this is the big question ahead of the US election.
Yeah, it's a fascinating question. What about oil? I mean, you can also say ahead of the U.S. election, but or even not. It's been a fascinating story to watch over the last several years. But I mean, we're really seeing some daylight between where it used to be and where it is now, the price of oil.
Yeah, absolutely. I mean, when you go back to summer of 2022, shortly after the invasion of Ukraine by Russia, the oil price was $130 a barrel. We're now looking at $70 a barrel. That is that's a really significant shift, and I don't really see that changing as long as the Chinese economy is in the state it's in, the US economy is starting to slow. And we've seen that with OPEC plus and their thinking around production caps and whether they increase production and they've they've pulled back. That I can't see the oil price going anywhere in the short term.
Rolling back to interest rates in the UK. So, how do the current interest rates impact mortgage holders in the UK and those planning to borrow?
Yeah. Mortgage rates are starting to come down in the UK. We've certainly passed the peak in terms of interest rates, but it's a slow burn process because many people, just as in other countries, are tied into fairly long term fixes. So people roll off their fixed rate mortgages at a slow pace, and so there are still many people who are enjoying low interest rates who are going to roll over into much higher interest rates. They're not going to roll over into the kind of rates that they were getting a year ago. Fortunately, it is starting to become more manageable, but they could very easily still see their interest rate double on their mortgage. So interest rates do need to come down, and this is the dilemma facing the Bank of England. It knows it needs to get interest rates down to stabilize the housing market, but it's concerned about inflation.
Just tell us a little bit more about sort of continue with the real estate story, the office story, the commercial real estate story that is still watched so carefully in many parts of the world.
Mm.
To what extent is that? I mean, the back to work story is there, but it's also a new appetite for office. How is that working its way through the system in the UK?
Well, it's interesting. I'm glad you asked me that because I was talking to our head of real estate just last week about this. I have never seen him so enthusiastic about the opportunities in
Really?
not just the UK, but the European real estate market. I mean, there's been a big correction in property prices, in commercial property prices over the last 2 or 3 years, and he is convinced that this is, a really good
This is the moment.
time. This
Mm,
is the moment,
interesting.
and we are seeing activity increasing, and but it's just really interesting because I mean I talk to this guy regularly. Every 3 months I have a catch up with him and talk about what's going on in the property market. He was super enthusiastic.
So that there's the trough story because it's we've all been sort of wondering when the downhill clip actually lands for so many parts of the world. And but so it's in line with the interest rates coming down in the UK. I mean, can you point directly to that, or is it more of a time people have been able to work their way through this? Investors have worked their way through this
Yeah,
period.
it's a combination of the fact that we've had this big correction in prices and the fact that the outlook now is, the direction of travel for interest rates is kind of set now. I think people accept that it is heading down, and you can still lock in very attractive yields as an investor. So property starts to look like a very attractive asset class.
What's the most important thing to investors over the next 6 months, would you say? I mean, it would have to be a known, I guess.
Yeah. I mean, I think well, two things. It's clearly the US election outcome is the big unknown. It's the known unknown.
It's the known unknown.
We know
Yes.
it's coming, but we really don't know what the outcome is going to be because
Right.
it's super close, and it has big implications. The known, I think, but it's still important, is the direction of interest rates, because what really matters is where it doesn't matter whether it's a 50 basis point cut now or 25. What matters is where interest rates end up in 2 years' time, and ultimately that will be decided by whether the market has got it right on the soft landing or whether they've underestimated the possibility of a hard landing.
Fascinating. It is so interesting to get your views, particularly on the backs of this big UK budget that's going to be presented in about a month's time. Delighted to speak with you today, Tom Stevenson. Thank you.
Thanks, Pamela.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.